Micron just lost $138 billion in market value in a single day, not over a month, in one trading session, the largest single session wipeout for the company in its entire history. A few weeks back, I made a video about the AI bubble. Some of you agreed, some of you told me I was being dramatic, some of you texted your uncle who day trades semis, and that's fine. But last week, something happened that changed the conversation. What I want to show you is why this specific sell-off is different from every other AI dip you've seen since 2023. Because this one didn't come from a tweet. It didn't come from a Fed meeting. It came from inside the machine itself. Let's start with the numbers because they matter. On July 1st, Micron shares dropped 13% in one session. Intel fell 9%, AMD dropped 7%, SanDisk lost 10%. The VanEck Semiconductor ETF, the thing your index fund almost certainly holds, shed 5% in a day after gaining 71% in the prior quarter alone. Nasdaq lost 2.2%. S&P 500 lost 1.5%. In one afternoon, the AI trade coughed up more market cap than most countries produce in a year, and here's the part nobody put on a banner. Micron, before this drop, was up 884% over the past 12 months. 884. That's not a growth stock. That's a rocket ship with the seatbelt sign turned off. When something goes up 884%, it doesn't take much for the market to remember that gravity is technically still a rule. But that's the surface. Here's the actual reason the machine started coughing. 2 days before Micron's sell-off, SK Hynix, the second largest memory chip maker on the planet, quietly told analysts they were slowing production of high-bandwidth memory, the specific type of memory that Nvidia's AI chips physically cannot function without. Now, memory manufacturers do not slow production because they feel like it. They slow production because they see the order book flattening, because customers are pulling back, because someone, somewhere, in the actual factory, is looking at demand signals and thinking, this doesn't look like it's growing anymore. And when the guys who make the picks and shovels start whispering to each other about slowing down, you don't need a Bloomberg terminal to know what that means for the guys buying the picks and shovels. Here's where it gets awkward, because a week later, Apple raised prices on some of its products. And in the fine print of their explanation, they mentioned that memory costs had gone up. Read that sentence again. Memory costs went up. Apple, the most vertically integrated hardware company on the planet, is being squeezed by the same memory shortage that's fueling the AI boom. Which means one of two things has to be true. Either AI demand is still real, in which case regular consumers are about to pay AI infrastructure prices for their next iPhone, or AI demand is starting to soften, in which case the memory pricing power is going to collapse, and Micron's 884% gain is going to look, in retrospect, like a very expensive misreading of the room. The market spent last Wednesday pricing in that second scenario. That's what a $138 billion wipeout looks like. Now here's the part. Your 401k is going to want you to skip, so don't. If you own any large cap American index fund, you own Nvidia. If you own Nvidia, you own about 8% of the S&P 500 concentrated in a single semiconductor company. If you own the Nasdaq 100, that number is closer to 12%. When Micron drops 13 in a day, that's felt in dozens of ETFs that regular Americans hold in their retirement accounts. When the SMH loses 5% in a session, that's not a Wall Street event. That's your paycheck contribution, the one you made 2 weeks ago on autopilot without thinking about it, losing 5% of its buying power on a company you probably could not name. Passive investing was sold to you as a way to avoid Wall Street's mistakes. In practice, it just makes you the last one to find out about them. And then there's the Fed. Because none of this is happening in a vacuum. Under the new Fed chair, Kevin Warsh, 9 out of 18 policymakers now support rate hikes in 2026. In March, that number was 0 to 9 in 3 months. When the cost of money goes up, growth stocks, the ones priced on years of future earnings, take the biggest hit. And nothing on planet Earth is priced more heavily on future earnings than AI semiconductors. So the setup is genuinely unusual. The infrastructure guys are slowing production, the end consumer companies are raising prices, and the Fed is turning hawkish while all of this happens. It is, mathematically, one of the more uncomfortable configurations the market has been in since the dot-com era. And nobody's calling it that yet because AI bubble popping doesn't fit on a CNBC banner. Here's what I told you a month ago, and I'm going to tell you again with more conviction now. Being right about AI doesn't mean you're right about AI stock prices. Cisco was right about the internet. It still spent 25 years underwater after the peak. Every parabolic tech run in modern history has ended the same way, and it's never because the technology was fake. It's because the price ran ahead of the math. The math for Micron at 884% gain in 1 year was never going to work. The math for Nvidia at 4.5 trillion in market cap was never going to work. The math for hyperscalers pouring $725 billion into infrastructure that generates $65 billion in revenue was never going to work. Last week, the market started doing that math out loud. That's what you were watching. That's what the $138 billion drop meant. The bubble hasn't fully popped. Nvidia is still worth more than most European countries combined. Micron, even after the 13% drop, is still up 260% for the year. This is not the crash. This is the trailer for the crash. The moment where the audience starts to realize the movie might not have a happy ending. If you have money in an index fund and you haven't looked at what's inside it in the last month, this is your reminder to look. Not to panic, not to sell everything, just to know what you own. Because the people who got hurt worst in 2000 weren't the ones who understood the risk. They were the ones who had no idea what was inside their portfolio until it was too late. If this changed how you see the numbers, subscribe.